From the bustling trading floors of Wall Street to the quiet corners of a farmer's market, one thing connects us all: money. But what exactly money? It's not just those colorful pieces of paper in your wallet or the numbers on your bank statement. Money, at its core, is an idea. A powerful concept that has shaped civilizations and fueled the engine of human progress for millennia. Imagine a world without money. You have a surplus of grain, but you need tools. You'd have to find someone willing to trade their tools for your grain, a system known as bartering. But what if the toolmaker doesn't need grain? What if they want livestock or cloth or something else entirely? The complexities of bartering would quickly bring trade to a standstill. Money solves this problem. It acts as a universal language, a common denominator that everyone understands and accepts. It facilitates trade, allowing us to exchange goods and services smoothly and efficiently. It gives value to our labor and enables us to store that value for future use. The story of money is the story of humanity itself. It's a tale of innovation and evolution, of booms and busts, of trust and betrayal. From the earliest forms of commodity money like seashells and cattle to the sophisticated digital currencies of today, the evolution of money has mirrored our own journey as a species. Understanding money is about more than just balancing your checkbook or investing in the stock market. It's about understanding the very fabric of our society. Money influences everything from the food we eat to the houses we live in, from the art we create to the wars we wage. In this exploration of the fascinating history of money, we'll embark on a journey through time. We'll trace the origins of money from its humble beginnings to the complex financial systems we see today. We'll delve into the rise of banks, the invention of interest, and the birth of financial markets. Along the way, we'll uncover the brilliant minds and the scandalous events that have shaped the financial world we know. We'll learn from the mistakes of the past and explore the challenges and opportunities that lie ahead. So fasten your seatbelts and get ready for a thrilling ride through the history of money. Before the concept of money emerged, our ancestors relied on a system known as bartering. Imagine a time when you couldn't simply walk into a shop and buy what you needed. Instead, you had to find someone who had what you wanted and was willing to trade it for something you had. It was like a giant, never-ending game of I'll trade you for your. This system had its limitations. First, finding the right trading partner could be incredibly time-consuming. You might spend days, even weeks, searching for someone who both had what you needed and needed what you had. It was a barter-based economy's version of finding a needle in a haystack. Second, bartering relied on the double coincidence of wants. Both parties had to desire what the other possessed, a rare alignment indeed. What if the skilled hunter wanted a new fishing net, but the net maker only needed their tools repaired? This mismatch of desires could stall trade completely. Finally, bartering lacked a standard measure of value. How many clay pots equaled a goat? Was a cow worth more than a cartload of wheat? Without a common unit of account, determining the relative value of goods was subjective and prone to disputes. As societies grew larger and more complex, the limitations of bartering became increasingly apparent. The need for a more efficient and standardized system of exchange became paramount. This led to the emergence of commodity money, items that had intrinsic value beyond their use as money. Early forms of commodity money varied widely across cultures and regions. In some societies, livestock, such as cattle or sheep, served as the primary form of currency. Their inherent value as a source of food, milk and hides made them a widely accepted medium of exchange. In other parts of the world, agricultural products like grain or salt took center stage. These commodities were highly valued for their role in sustenance and preservation, ensuring their acceptance in trade. Seashells, beads, tools, and even weapons also found their place as forms of commodity money. However, commodity money also had its drawbacks. Livestock could be prone to disease, Grain could rot and seashells could be bulky and difficult to transport. Gradually, the search for more durable, portable and divisible forms of money led to the adoption of metals. The transition from commodity money to metallic currency marked a significant step in the evolution of money. Metals, particularly gold and silver, possessed several qualities that made them ideally suited as mediums of exchange. They were durable, divisible, portable, and relatively scarce, ensuring their value. Initially, metals were traded in their raw form, weighed and measured in each transaction. However, this process was cumbersome and time-consuming. Around the 7th century BC, the Lydians, an Anatolian civilization, revolutionized commerce by introducing the world's first coins. These early coins, typically made of electrum, a naturally occurring alloy of gold and silver, bore the stamp of a king or temple, guaranteeing their weight and purity. This standardization was a game changer. For the first time, people could trade with confidence, knowing the value of the coins they received. The invention of coinage spread rapidly throughout the ancient world, facilitated trade, and fueled economic growth. It paved the way for the development of more sophisticated financial systems, including the emergence of banks, which we'll explore in the next act. As economies flourished and trade routes expanded, a new challenge emerged: the safekeeping of wealth. Merchants, who often transported large sums of coins, faced the constant threat of theft or loss. The need for a secure and reliable system for storing and transferring money became increasingly apparent. This led to the dawn of banking, a revolutionary concept that would transform the world of finance. Early banks emerged organically, often from existing businesses. Temples, with their perceived sanctity and security, became natural repositories for valuables. Individuals entrusted their gold and silver to these religious institutions, receiving clay tablets or other forms of receipts as proof of deposit. These receipts, in turn, could be exchanged for goods and services, effectively functioning as early forms of currency. Similarly, moneylenders, who had long played a role in local economies, began to expand their services. They provided loans to individuals and businesses, facilitated money transfers between cities, and even engaged in early forms of currency exchange. These moneylenders, often operating from prominent positions in marketplaces or trading hubs, gradually evolved into more formalized banking institutions. The emergence of banks addressed a critical need in burgeoning economies. They provided a safe haven for wealth, reducing the risks associated with holding large sums of money. They facilitated trade by enabling secure and efficient transfers of funds, fostering economic growth and prosperity. Pinpointing the precise location of the very first bank is a task shrouded in the mists of time. However, historical evidence points to several ancient civilizations that developed sophisticated banking practices independently. Let's journey back in time to explore some of these early financial pioneers. In ancient Mesopotamia, as early as the 3rd millennium BC, temples functioned as de facto banks, accepting deposits, granting loans, and even charging interest. Clay tablets unearthed from this era reveal detailed records of financial transactions, providing a glimpse into the surprisingly advanced banking practices of this ancient civilization. Across the Mediterranean, in ancient Greece, temples also played a significant role in finance. The Temple of Artemis at Ephesus, one of the 7 wonders of the ancient world, was renowned for its vast wealth and its role as a major lending institution. Private banks, often established by prominent families, also flourished in Athens, Corinth, and other Greek city-states. The Roman Empire, known for its vast infrastructure and trade networks, witnessed the rise of powerful banking families. The Medici, based in Florence, rose to prominence during the Italian Renaissance, amassing vast wealth and influence through their banking activities. The Rothschilds, with roots in Frankfurt, established a global banking dynasty in the 18th century, financing empires and shaping the course of history. For centuries, coins reigned supreme as the primary form of currency. However, the weight and bulk of metal money posed challenges for large-scale transactions and long-distance trade. Imagine transporting a chest full of gold to purchase a shipload of silk. A logistical nightmare fraught with risk and inconvenience. The search for a more efficient alternative led to the emergence of paper money, a revolutionary concept that would forever change the financial landscape. Early forms of paper money emerged in China during the Tang dynasty in the 7th century. Merchants seeking to avoid carrying heavy strings of copper coins began depositing their money with trusted shops and receiving promissory notes in return. These notes, initially handwritten on pieces of paper, circulated as a medium of exchange, representing a claim on the deposited coins. The concept of paper money spread westward along the Silk Road, reaching Europe by the 13th century. Marco Polo, the famed Venetian explorer, marveled at the use of paper money in Kublai Khan's Yuan dynasty, describing it as a system so unusual that it's hard to believe. However, it would take several centuries for paper money to gain widespread acceptance in the West. The transition to paper money was not without its challenges. Early banknotes were often backed by the gold and silver reserves of issuing institutions, but the temptation to print more notes than could be redeemed led to inflation and financial instability. Trust, a cornerstone of any monetary system, proved to be a fragile commodity. The concept of interest, the idea that money itself could generate more money, marked a pivotal moment in the evolution of finance. Imagine planting a seed that not only grows into a tree, but also produces more seeds, a self-perpetuating cycle of growth. That's the essence of interest, the financial equivalent of nature's bounty. But how did this seemingly magical notion come about? In early economies, lending was often driven by necessity. A farmer might borrow grain during a lean season, promising to repay the loan with a share of the harvest. A merchant might seek funds for a trading expedition, offering a portion of the profits as an incentive. These early forms of lending, while informal, laid the groundwork for the concept of interest. As banking became more established, so too did the practice of charging interest on loans. Banks, acting as intermediaries between savers and borrowers, realized they could profit by charging a fee for the use of money. This fee, expressed as a percentage of the amount borrowed, became known as interest. The introduction of interest had profound implications. For lenders, it provided a powerful incentive to save and invest their money, knowing it could generate a return. For borrowers, it opened up new opportunities to finance ventures, expand businesses, and even purchase homes, albeit at a cost. The financial landscape was forever changed. The history of lending is inextricably linked to the human desire for progress. From the earliest agricultural loans that helped farmers sow the seeds of civilization, to the modern mortgages that enable families to purchase homes, credit has played a pivotal role in shaping our world. In ancient Mesopotamia, clay tablets dating back millennia record loans granted for everything from land purchases to business ventures. These early loans, often accompanied by high interest rates and strict penalties for default, highlight the risks and rewards associated with lending and borrowing. During the Middle Ages, European trade flourished thanks in part to the rise of merchant banking families like the Medici and the Fuggers. These financial powerhouses provided loans to kings, financed wars, and bankrolled the voyages of exploration that led to the discovery of the New World. The Industrial Revolution witnessed an explosion in the demand for credit. Entrepreneurs sought capital to build factories, inventors needed funding to develop new technologies, and governments required loans to finance infrastructure projects. Banks responded by developing new forms of lending, such as overdraft facilities and lines of credit, to meet the evolving needs of a rapidly changing world. From simple savings to sophisticated investments, the rise of financial products. As economies grew more complex, so too did the financial instruments used to manage wealth and facilitate trade. What began with simple savings accounts and loans has evolved into a vast and intricate web of financial products designed to meet the diverse needs of individuals, businesses, and governments. One of the earliest forms of financial innovation was the development of deposit accounts. Banks, recognizing the need for a safe and convenient way for individuals to store their money, began offering interest-bearing accounts, providing an incentive for people to entrust their savings to these institutions. As the demand for investment opportunities grew, banks and other financial institutions responded by creating a wide range of investment products. Mutual funds, which pool money from multiple investors to purchase a diversified portfolio of assets, emerged as a popular way for individuals to participate in the stock market without having to pick individual stocks themselves. Insurance, another cornerstone of modern finance, also has ancient roots. Early forms of insurance, such as maritime insurance, protected merchants from the financial losses associated with shipwrecks and piracy. Over time, insurance evolved to cover a wide range of risks, from fire and theft to illness and death, providing individuals and businesses with a safety net against life's uncertainties. Few names are as synonymous with banking and finance as the Medici. This Florentine family, rising from humble beginnings in the 14th century, ascended to become the undisputed masters of money and power during the Italian Renaissance. Their story is a captivating blend of financial acumen, political intrigue, and unparalleled patronage of the arts. The Medici's rise to prominence began with Giovanni di Bicci de' Medici, a shrewd businessman who established the family bank in 1397. He recognized the burgeoning trade in Florence, a city at the crossroads of commerce, and positioned the Medici Bank to finance the growing needs of merchants, artisans, and even the Catholic Church. Giovanni's son, Cosimo de' Medici, inherited his father's business acumen and political savvy. He expanded the Medici Bank into a vast financial network with branches spanning across Europe. Cosimo understood that wealth alone was not enough to secure lasting power. He cultivated relationships with influential families, secured key positions within the Florentine government, and used his wealth to shape the city's destiny. Under Cosimo's patronage, Florence experienced a golden age of artistic and intellectual flourishing. He commissioned works from renowned artists like Donatello, Brunelleschi, and Michelangelo, transforming Florence into the cradle of the Renaissance. The Medici's legacy, etched in stone and painted on canvas, stands as a testament to the profound impact of their financial prowess. As economies grew increasingly complex and interconnected, the need for a more stable and regulated financial system became paramount. This led to the emergence of central bank institutions tasked with overseeing monetary policy, managing currency reserves, and acting as lenders of last resort in times of crisis. The concept of a central bank can be traced back to 17th century Sweden with the establishment of the Riksbank in 1668. The Riksbank, initially a private institution, gradually assumed a more prominent role in managing the Swedish economy, setting the stage for the development of modern central banking. The Bank of England, founded in 1694, played a pivotal role in shaping the concept of central banking as we know it today. Established to finance King William III's wars against France, the Bank of England quickly evolved into a powerful institution. issuing banknotes, managing government debt, and regulating the nation's money supply. The United States, after experiencing periods of financial instability in the 19th century, established the Federal Reserve System in 1913. The Federal Reserve, often referred to as the Fed, consists of 12 regional banks and a central board of governors, tasked with promoting economic stability, maximizing employment, and maintaining stable prices. Central banks, though often operating behind the scenes, play a crucial role in modern economies. They act as guardians of the financial system, striving to prevent crises, promote stability, and foster sustainable economic growth. The late 20th and early 21st centuries witnessed a technological revolution that would fundamentally alter the way we interact with money. The rise of computers, the internet, and mobile devices ushered in the era of digital finance, transforming money from tangible objects into lines of code zipping through cyberspace at the speed of light. Early forms of digital finance emerged in the 1960s with the development of electronic funds transfer systems. These systems, initially used by banks to transfer funds between accounts electronically, paved the way for the automation of financial transactions. The advent of the internet in the 1990s revolutionized the financial landscape. Online banking emerged, allowing customers to access their accounts, transfer funds, and pay bills from the comfort of their homes. E-commerce platforms flourished, creating new avenues for businesses to reach customers globally and enabling consumers to purchase goods and services with unprecedented ease. The dawn of the 21st century witnessed the rise of mobile payments. Smartphones equipped with near-field communication technology transformed into digital wallets, allowing users to make contactless payments with a simple tap. Mobile payment platforms such as Apple Pay, Google Pay, and Alipay rapidly gained popularity, particularly in Asia, further reducing the reliance on cash and traditional payment methods. The emergence of cryptocurrency, a decentralized digital currency based on blockchain technology, marked another significant development in the evolution of money. Bitcoin, the first and most well-known cryptocurrency, sparked a global debate about the future of money, challenging the traditional role of central banks and governments in controlling the monetary system. The year is 1720. England is abuzz with talk of unimaginable riches to be made in a far-off land, the South Seas. The South Sea Company, a joint stock company granted a monopoly on trade with the Spanish colonies in South America, has captured the imagination of the nation. Investors, eager to share in the promised bounty of gold and silver, are clamoring to buy shares. The company, however, is built on shaky foundations. Trade with the Spanish colonies is limited, and the promised riches are more fantasy than reality. Undeterred, the company's directors, fueled by greed and ambition, engage in a campaign of relentless promotion, hyping the stock and encouraging speculation. The price of South Sea Company shares skyrockets, rising from £128 in January 1720 to over £1,000 by June. Fortunes are made overnight, at least on paper. Everyone, from aristocrats to shopkeepers, is caught up in the speculative frenzy, mortgaging their homes and investing their life savings in the hope of striking it rich. But like all bubbles, the South Sea bubble is destined to burst. As the summer of 1720 wears on, doubts begin to creep in. Investors realize that the company's promises are hollow, and the price of shares begins to plummet as rapidly as it rose. By September, the bubble is fully deflated, leaving countless investors financially ruined. The South Sea bubble stands as a cautionary tale about the dangers of speculation, market manipulation, and the human tendency towards irrational exuberance. It serves as a stark reminder that even the most promising investments can turn sour, and that greed, if left unchecked, can have devastating consequences. The stock market crash of 1929, a day forever etched in financial infamy as Black Tuesday, marked the beginning of the Great Depression, the most severe economic downturn in modern history. The world watched in disbelief as stock prices plummeted, wiping out billions of dollars in wealth and ushering in a decade of hardship and despair. The causes of the Great Depression were complex and multifaceted, ranging from over-speculation in the stock market and excessive consumer debt to agricultural overproduction and global trade imbalances. The collapse of the American economy, the world's largest at the time, sent shockwaves across the globe, plunging nations into economic turmoil. The human toll of the Great Depression was staggering. Unemployment soared to unprecedented levels, reaching 25% in the United States. Breadlines stretched for blocks as desperate families struggled to put food on the table. Businesses shuttered, banks failed, and the very fabric of society seemed to unravel. The Great Depression had a profound impact on economic thought and policy. It led to the development of Keynesian economics, which advocated for government intervention in the economy to stimulate demand and mitigate recessions. It also spurred the creation of social safety nets, such as unemployment insurance and social security, to provide a measure of protection for those most vulnerable to economic downturns. The Great Depression serves as a stark reminder of the interconnectedness of the global economy and the devastating consequences of economic instability. It highlights the importance of sound economic policies, financial regulation, and a social safety net to protect against the vagaries of the market and ensure a more equitable and resilient society. The year 2008 witnessed a financial earthquake that shook the global economy to its core. What began with a seemingly contained crisis in the American housing market quickly escalated into a full-blown global meltdown, exposing the interconnectedness and fragility of the modern financial system. The seeds of the crisis were sown in the years leading up to 2008, fueled by a combination of lax lending standards, deregulation of the financial industry, and the unchecked growth of complex financial instruments such as mortgage-backed securities. Subprime mortgages, loans granted to borrowers with poor credit histories, were packaged into seemingly safe investments and sold to investors worldwide. As long as housing prices continued to rise, the system worked. But when the housing bubble burst, triggering a wave of defaults on subprime mortgages, the value of these mortgage-backed securities plummeted, sending shockwaves through the global financial system. Banks, saddled with toxic assets, faced liquidity crises. Credit markets froze, businesses struggled to obtain loans, and the global economy spiraled into recession. Governments around the world intervened with massive bailouts and stimulus packages in an attempt to avert a complete financial collapse. The 2008 financial crisis had far-reaching consequences. It led to the loss of trillions of dollars in wealth, triggered a global recession, and exposed the systemic risks inherent in the modern financial system. It also sparked a wave of regulatory reforms aimed at strengthening financial institutions, increasing transparency, and preventing future crises. Throughout the ages, certain families have shaped the world of finance, their names whispered in gilded halls and etched into the annals of economic history. These dynasties, through a potent blend of ambition, strategy, and sometimes a touch of ruthlessness, built financial empires that spanned continents and influenced the destinies of nations. One such dynasty, the Rothschilds, rose from the Jewish quarter of 18th century Frankfurt. Meyer Amschel Rothschild, a brilliant and ambitious coin dealer, recognized the power of finance in a world riven by war and revolution. He strategically placed his 5 sons in major European cities, creating a network of banks that financed governments, funded industries, and amassed unimaginable wealth. The Rothschild name became synonymous with international finance, their influence shaping events from the Napoleonic Wars to the construction of the Suez Canal. Across the Atlantic, another dynasty took root, the Morgans. J.P. Morgan, a towering figure in American finance, built his empire in the late 19th and early 20th centuries. He financed railroads, consolidated industries, and bailed out governments, earning the moniker Jupiter Morgan for his Olympian influence. His legacy lives on in J.P. Morgan Chase, one of the world's largest financial institutions. These dynasties, while amassing immense wealth, also left an indelible mark on philanthropy and the arts. The Rothschilds, known for their patronage of hospitals, schools, and cultural institutions, believed in using their wealth to effect social change. The Morgans, particularly J.P. Morgan Jr., donated vast sums to art museums, libraries, and medical research, shaping the cultural landscape of their time. Behind the imposing facades of banks, amidst the rustle of banknotes and the click of computer keys, lie countless stories, tales of innovation and folly, of fortunes won and lost, and of the enduring human fascination with money. Let's delve into the vaults of history and uncover some of banking's lesser-known curiosities. Did you know that the world's first stock exchange, a precursor to the bustling trading floors of Wall Street, wasn't a grand building but a humble coffee house? In 17th century London, Jonathan's Coffee House became a meeting place for merchants and investors, where they traded shares in joint stock companies, laying the groundwork for modern stock markets. Speaking of stock markets, the iconic New York Stock Exchange, a symbol of American capitalism, traces its roots back to a simple agreement signed under a buttonwood tree in 1792. 24 brokers and merchants seeking to bring order to the chaotic world of securities trading formed an association that would evolve into the world's largest stock exchange by market capitalization. But banking's history isn't all about gilded cages and soaring profits. Consider the curious case of the Bank of Scotland's missing £100,000 in 1844. The bank's cashier, a trusted employee, disappeared with a small fortune in banknotes, sparking a nationwide manhunt and leaving a trail of unanswered questions. The missing cashier, presumed to have assumed a new identity, was never found, leaving the mystery of the vanished banknotes to linger in the annals of banking lore.